Canada's economy is collapsing, but they're not the only ones. I'm Steve Van Metre. Business confidence has collapsed, consumer spending is tanking, and the government is panicking. A global catastrophe is unfolding. Plus, while others buy the dip, my subscribers are up 8% in 11 days. Stay tuned to the end of the show to learn how you too can beat the machines for big profits. Now let's head over to Bloomberg, where we find out what happened in Canada and answer the question, who's next? As small business optimism in Canada collapses to a 25-year low. And my friends, this is a major warning sign, because what it means is Canada's economy is headed right into a recession. Because when businesses lose confidence, it's all about the consumer. It means consumers have cut their spending. It means they're tightening their belts. And for businesses, the next move is going to be some major layoffs. And for the Canadian economy, all signs now are pointing to a massive recession. The question is, who do they bring down with them? The Business Barometer Index fell to 25 this month, according to a flash poll of over 1,000 firms taken in early March. That's the lowest reading on record dating back to 2000. And what we can see after the U.S. presidential election is that confidence not only in U.S. businesses soared, but in Canadian businesses as well. But look what's happened since. It's plunged. And again, this is a massive warning sign, because what it's telling us is Canada's economy is headed into recession. The question remains, who else are they going to drag down with it? Nearly 60% of respondents expect their business performance to be somewhat weaker or much weaker 12 months from now, a similar proportion to March of 2020 when the shutdowns of COVID-19 pandemic begin. So when businesses start to see a slowdown coming, not only do they tighten their belt, but it affects their workers. They're going to cut hours. They're going to cut jobs. And for the Canadian economy, this is a massive problem. Firms expecting for inflation over the next year are also rising, as average price plans jumped 3.7% in March from 3% in February. The historical average is 2.2%. So at the same time, businesses are projecting their business and the economy are going to slow down. They're going to raise their prices. And this is a very dangerous sign. And everything points to that we're headed into a recession. And let's take a look at some U.S. data, because the signs are very clear of what's coming. As we look at real gross domestic product in blue against the consumer price index in red, both shown on a year-over-year rate of change. Let's go back to the late 1980s and what happened. Growth slowed down, and that's exactly what Canadian businesses are projecting is coming for the next 12 months. At the same time, the consumer price index headed higher. The same thing businesses in Canada are saying they're going to do. That's raise prices. What do you get? The 1991 recession. And what you can see is this is the exact recipe for every recession. You get slowing growth and rising prices right into the dot-com bubble. You get, again, rising prices, slowing growth right in the global financial crisis. So when we look at where we're at now, Canadian businesses are projecting a further slowdown in growth. At the same time, they're saying prices are going to rise. And based on history, that means the Canadian economy is headed right into a recession. Now, I want to know from you, do you think the U.S. economy is immune to what happens in Canada and other parts of the world? Do you think if Canada heads into recession that we won't? Weigh in the comments below, because I'd like to know from you what you think, because here's something that I've said about the tariffs and what the objective is. If other economies head into recession before we do, well, it means they're likely to come to the negotiating table. The question is, if Canada goes down, do we follow right away, or do we stand strong? Weigh in the comments below. Love to hear from you, because economists say a prolonged dispute would send the country into a recession, which is exactly the case I've been making. The Bank of Canada has estimated about an 8.5% hit to exports if it lasts a year. Prices are also expected to rise amid a weakening currency, higher import costs, and retaliatory tariffs. So here you're finally starting to see that the political elites, a lot of these experts, are finally waking up to what I've been saying, and that is if you get slowing growth and rising prices, it's going to impact the labor market, and you head right into a recession. In this case, the Bank of Canada actually knows it. Now, on a positive note, 86% of firms said their current business situation was good or satisfactory, little change from the prior month. Now, that may suggest respondents weren't yet feeling the immediate impact of the tariffs in the days after they were imposed. And that's true, because I've talked to some business owners and I've asked them, how are the tariffs impacting you? And they said, well, we're not seeing it yet because we loaded up on inventory. Now, once we clear through our inventory level, that will be a different story. But there's something that shouldn't be impacted by the tariffs, and that's your trading account. And while a lot of investors are buying the dip in major U.S. equity indices, our CTA Timer Pro that looks at at machine positioning and positions our subscribers ahead of massive buying. It nailed the trade on Brazilian equities, up over 8% in the last 11 days. If you want to beat the machines and make big money in the market, stay tuned to the end of the show or grab the links in the description. Be sure to use the coupon codes for a free 30-day free trial. Because while businesses are saying they don't see any effects yet, consumers are saying that we're feeling it as retail sales in Canada weaken amid trade worries and a tax break. An advanced estimate suggests receipts for retailers fell 0.4% in February, which follows a 0.6% decline in January. Now, what's interesting is while business confidence plunged, they said that current conditions were good or satisfactory. What we're hearing from Canadian consumers is anything but. They're cutting their spending because they're worried about the economy and their jobs. The declines follow a 2.6% spike in sales in December that coincided with the start of a break in sales taxes on some items. So the first back-to-back decreases since mid-2023 may point to mounting pressures on consumption from consumers about the U.S.-Canada tariff war. So here's what's interesting is we saw Canadian consumers do the same thing U.S. consumers did, and that was front-run the tariffs. But despite the fact that they got a break in sales tax, it wasn't enough to spur consumption. Now, if you think about what we just heard from Nike, they said that they discounted a bunch of their old merchandise and it didn't really help. What have we heard from Lululemon? They said, look, store traffic is down. What did FedEx say? Well, they had to mention that shipping demand is down. So what we're seeing here is prices are rising and paychecks are shrinking, meaning consumers can't afford any price increases, let alone where they're at today. The Bank of Canada reduced borrowing costs for the 7th straight meeting last week, meaning rate cuts are having absolutely no effect on consumption. And this is something I want you to understand because we talk about how central bank policy makes no difference to the real economy, to the real consumer. And here's the evidence. 7 straight meetings they've been cutting rates. And what happens? Consumers cut spending. And surveys show that Canadians are increasingly worried about their job security and financial health and plan to spend more cautiously, meaning what Canadian consumers are doing is they're starting to increase their savings rates. This is something that U.S. consumers are going to do as well. And when that happens, well, it means retail sales plunge regardless of central bank policy. And here we can see, looking at the U.S. data, as we take a look at real retail sales in blue against the federal funds rate in red. And what we can see going back to 1994 is there was a deceleration in real retail sales for 2 years, but the Fed didn't react until retail sales were clearly coming down. We see that happen again going into the dot-com bubble. Real retail sales peaked right around 1999 and were decelerating. The Fed was still hiking rates at that point and didn't start cutting until there was a noticeable slowdown. Well, how about going into the global financial crisis? Well, retail sales peaked back in 2005, and again, the Fed was raising rates to crush demand. It wasn't until we were almost into the crisis that the Fed decided to cut rates. At that point, retail sales were hovering just over zero and plunged into a massive contraction. We see the same thing happen right around 2018 and 19. Retail sales went negative. The Fed was raising rates to crush demand, and look what happens now. For the last 3 years, retail sales have largely been negative on an inflation-adjusted basis. The Fed raising rates to crush demand, now saying, look, we may not need to cut rates anytime soon because we feel that rising prices is going to be a problem and we need to keep monetary policy relatively tight to further crush demand. But if you look north to what's happening in Canada, what consumers there are saying is, look, rising prices are crushing demand because our paychecks are shrinking. And when businesses lose confidence, as we started out the show to begin with, what they're going to do is cut hours and cut jobs. And again, that's all going to backfeed into a loop here that's going to lead to less confidence from consumers and less spending. The federal government temporarily waived sales tax on some purchases between December 14th and February 15th, including alcohol, books, and games. Retail sales surged at the end of last year as shoppers front-run the tariffs and took advantage of the break before holidays. But what happened after that? What did we see? Demand fell. So what does this tell us? Sales tax breaks, they don't work. Price cuts, they don't work either. And cutting the funds rate, well, that doesn't have any effect at all. The downbeat data today appears to be mostly a normalization activity after spending was pulled forward in December for the start of the GST holiday. This is from an economist at the Canadian Imperial Bank of Commerce. So the experts are saying, this is normal because there was so much demand brought forward from the end of the year that this was just normal expectations. Consumers were paring back, but don't worry, they're going to increase their spending. But that's not the case, because when consumers get worried, they tighten their belts. They increase their savings because the fear is they're going to lose their job. And that's exactly what businesses are saying in Canada. They're saying, wait a minute, our outlook over the next 12 months is plunging because we're seeing a change in consumption. And here you can see the evidence as we look at real retail sales in blue against the personal savings rate. Let's go back going into the dot-com bubble. What do we see? Retail sales heading lower starting around 1999. And look what happens with the personal savings rate. It's heading higher. So the real truth of what's happening is consumers were losing confidence in the economy and they were starting to save more and tighten their belts, which has an immediate impact on retail sales. And as that happens, what do you see retailers and other businesses across the supply chain do? Well, they cut hours and cut jobs, sends right into a recession. You can see around 2005 into 2006, as retail sales peaked and slowed down, what happened is consumers were increasing their savings rate right in the global financial crisis. How about around 2012? What happened? We almost faced a double-dip recession. Why is that? Consumer savings were rising and demand was falling. See that happen in late 2017 and 2018, and then it happens right around 2022. That big drop in retail sales, what had a matching big increase in the personal savings rate. And the recent increase in retail sales had everything to do with Americans drawing down their savings. So based on what we're seeing from Canadian consumers is they're increasing their savings rates, their demand is going down. The question is, will American consumers cut their spending? I want to know from you. Weigh in the comments, have you already started cutting your spending? Are you planning to? Let me know. Or if you're a business, what are you seeing from your customers? As Carney unveils Canada tariff relief, nation-building reforms as Canadian government goes into all panic mode in a bid to mitigate the economic hit from sweeping import taxes on Canadian goods proposed by U.S. President Donald Trump, Canada will temporarily allow businesses to defer payments of corporate income tax and consumption tax remittances. Canada will also deploy a new government financing facility and make it easier and faster for affected workers to access government support programs without detailing the budget impact. Well, it's going to have a massive impact on the budget, but what Carney's admitting to the fact that they're going to increase the pace at which workers can get assistance, it's telling us that businesses are going to start laying off in a big way, and the government knows it. So you can see all the recipe we talk about for stagflation: rising prices, slowing demand, a lack of confidence, leads to rising unemployment, and in this case, a Canadian recession. The question is, if they had a recession, will the U.S. economy follow, or will they be the first, or will others go with them? We'll find out soon enough. But Carney didn't stop there. This is how much panic is going on at the top. Under pressure from U.S. import tariffs already in place and the threat of new duties coming on April 2nd, they've imposed retaliatory measures. And on top of that, they announced measures aimed at stimulating investment and accelerating the movement of goods, services, and workers between the country's 13 provinces and territories. And you can see this is all-out panic at the top as the Canadian government starts to wake up to the realization that in a matter of months, their economy could be in a full-blown recession. And I don't think the U.S. economy is immune here. I think a lot of other economies are going to fall with them. But the real issue here, it's all about the tariffs. And the moment their economy breaks, well, you're going to watch them run to the negotiating table and try to get these tariffs off the table. Because Australia's employment plunge prompts boost and rate cut bets, as Canada isn't the only one, as Australia's economy has now turned to the downside. Employment declined by 52,800, led by full-time roles, and that is a dangerous sign. It's one thing when you lose part-time jobs or temporary jobs, but when you lose full-time jobs at 52,800, it's a major warning sign. And that was compared to a forecast of a 30,000 increase. The jobless rate held at 4.1%, meaning a giant fall in participation as workers are losing confidence in the economy, meaning those who are losing their job realize there is no other work for them. And that's why this data says, well, the unemployment rate held steady at 4.1. But meanwhile, the currency slipped while the yield on policy-sensitive 3-year bonds extended an earlier decline as traders increased wagers on a near-term rate cut. Well, what the bond market's actually pricing in is the growth and inflation in Australia are going to head head down. That's why rates are responding as they are. Look for Canadian interest rates to come down, and at some point, we're going to see the U.S. rate market respond as well. Now let's take a look at the effects of what all of this means to the labor market as we look at real gross domestic product in blue against the consumer price index in red. Again, this is U.S. data, but now let's overlay the unemployment rate in green. And what do we see? Periods of slowing growth, rising inflation lead to rising unemployment and a recession. And so now you get the big picture of why the Canadian government is in all-out panic mode, because the next thing that's going to happen is the unemployment rate there is going to rise. There's going to be into a massive recession, and the only thing they can do at this point is run to the negotiating table and hope it's not too late. You can see again it happens in the global financial crisis. The missing picture was from before was the unemployment rate headed higher, and now what do we hear from the Fed? That growth is going to slow, prices are going to rise, and the unemployment rate is also going to head higher, meaning that the probabilities that the U.S. economy heads into stagflation and a recession is very high. The question is, can the policies of the current administration turn things around fast enough, or is it too late? Is the economy here already headed down that path? Again, wait in the comments below. Let them know what you think, because here's what the experts say. We see the job market weakening, and referring to Australia's labor market, but until the deterioration starts to show clearly across the gauges, we think the RBA will be reluctant to deliver swift reductions in the cash rate. So once again, we talk about how central bank policy does not work, and there's the evidence. They see the economy slowing down. You've lost 50,800 full-time jobs, and that's massive. And what's the response from the experts? Well, not to worry, the central bank will respond at some point when they're very clear that this is actually a downturn in the labor market. And today's data shows some of the expected softening in the labor market. While there's still challenges in our economy and people are still under pressure, we still have the lowest average unemployment of any government in the last 50 years. So here you see the government say, look, it's okay. 50,000 people can lose their job because we still have the lowest unemployment rate. And the reason you have the lowest unemployment rate is because those people who are losing their jobs don't see any opportunity to re-enter the workforce, so they're giving up. And that's not something to brag about. Even after reducing rates last month, Governor Michelle Bullock remained cautious on the prospect of further easing, worrying that prolonged tightness in the labor market could rekindle price pressures. So here you can see from a central bank governor, in the face of 50,800 full-time jobs being lost, that they're actually happy about it because they're worried that a tight labor market is going to send inflation higher when we already know the tariffs are going to do that. Instead, they're saying this is great news because fewer people at work means that inflation is going to come down. What they don't realize is this is a warning sign. We're seeing Australia's labor market collapse, telling us their economy is headed into recession. At the same time, business confidence in Canada falling. We see consumer spending tanking. All it tells us is Canada's economy also headed into recession. The question is, what other economies are soon to follow, and is the U.S. economy immune to that? We'll find out soon enough, but one thing that should be immune to any downturns, that's your trading account. Let's take a look at our Brazilian trade we put back on the 10th to our CTA Timer Pro subscribers, still up over 8%. You can see from our notes, we told them to buy it open. We've already hit our upside target, and we gave them risk control levels that we've increased right along the way. And here you can see that trade went on the boards on this red candlestick. It held a rising trend line, rising momentum, but the big key is machine positioning underneath here told us that on a historical basis, machines would have to be buyers here. Sure enough, they did, driving it right up to its 200-day moving average, hitting our upside target. Well, how do we do this? Well, each and every day we look at how machines are positioned across a broad equity, bond, currency, and commodity markets, and we run that against a historical overlay to find out if machines are correctly positioned, because when they're not, it tells us when they need to be buying and when they need to be selling. So we try to position our subscribers to get in before the machines buy, and that historical data is built right into our reports. Now, every day we look at those reports and I review them. I give you all the tradable signals, but I review every trade and give you my opinion on what the best trades are and stop loss levels for every one of them. We fully track all our open trades and returns. We give you a weekly update. Plus, I disclose how I'm trading my own reports. And on top of that, we give you a free 30-day free trial. That's right. Use the links in the description below. Grab that coupon code because we're so confident you can make money trading our report. We want your first 30 days to be on me. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.